Hey everyone, and welcome to The Explainer. Today we are diving straight into the actual mechanics of regional banking. We're going to use Trustmark Corporation's Q1 2026 financial results as our real-world anchor. The goal here is to get past all the dense corporate speak and figure out exactly how the gears of a regional bank actually turn.
$56.1 million, right? That is Trustmark's net income for just one single quarter. And honestly, it immediately begs the question, how exactly does a regional financial institution manage to generate tens of millions of dollars in profit in just 3 months? What's the actual on-the-ground machinery behind a massive number like that? Well, that is precisely what we're going to unpack today.
Okay, let's dive into this. Here is our roadmap. First, the Q1 2026 financial headlines. Second, margins and revenue generation. Third, balance sheet, loans and deposits. Fourth, credit quality and safety nets. And finally, returning value to shareholders.
Let's kick things off with Section 1, Q1 2026 financial headlines, peeling back the curtain on the bottom line. Now, we all know corporate filings can feel incredibly dry. So let's humanize this text a bit and see how management themselves actually viewed the quarter. Trustmark's president and CEO, Dwayne A. Dewey, put it like this. We continued to build upon the strong momentum from our record earnings in 2025. Our results reflect continued loan growth, stable credit quality, and an attractive core deposit base. So management's perspective is pretty clear here. It's really a narrative of carrying forward their past momentum while keeping everything completely stable.
And you know what? That momentum translates directly to this metric, 95 cents. That $56.1 million in net income we were just talking about equals exactly 95 cents in diluted earnings per share. This basically sets a clear baseline for the stock's quarterly performance, giving us the foundational number we need to start digging deeper. Moving right along to Section 2, margins and revenue generation, basically how the bank makes its money.
To really get bank revenue, you absolutely have to grasp the net interest margin. It is literally the gap between the cost of funds, which is the interest the bank pays out to you and me for our deposits, and the sale of funds, which is the interest they receive from lending that money out. Think of it exactly like a grocery store's markup on goods. A store buys milk at wholesale costs, sells it at a higher retail price, and keeps the difference. Banks do the exact same thing, just with dollars instead of dairy.
Now, Trustmark's actual markup for Q1 2026 came in at 3.81%. But here's the real takeaway. It's not just the number itself. It's the fact that this rate remained completely stable, totally unchanged from the prior quarter. In a volatile world of interest rates, maintaining a perfectly stable margin is a massive indicator of how a bank is managing its core operations.
But of course, a modern bank makes money outside of just charging interest. Actually, Trustmark generated a really impressive $42.3 million in non-interest income this quarter. Just looking at the breakdown, wealth management brought in $10.4 million, service charges on deposit accounts generated $10.7 million, mortgage banking pitched in $8.9 million, and bank card and other fees rounded it out with $8.0 million. It really highlights the diverse revenue streams a bank relies on beyond just the traditional lending desk.
All right, Section 3, the balance sheet, the core engine of loans and deposits.
So to generate that interest margin, a bank needs raw materials. In the banking world, that means deposits and loans. Trustmark holds $13.9 billion in loans held for investment, backed by an absolute mountain of total deposits sitting at $15.7 billion. And this brilliantly illustrates their liquidity position. Their $13.9 billion in loans represents 88.3% of their massive deposit base. They've essentially gathered more than enough raw deposits to safely fund the capital they're lending out.
But here's the real secret sauce. Not all of those deposits actually cost the bank money. Look at this, 19.7%, so nearly a fifth of their total deposits are non-interest-bearing. That means almost 20% of their raw material costs the bank absolutely nothing in interest. Zero. Because of this massive chunk of free money, they're able to drive the average cost of all their deposits down to a highly efficient 1.63%.
Let's shift gears to Section 4, credit quality and safety nets, preparing for the unexpected.
I want to pose this question directly to you. How big is this safety net? Think about it. When a financial institution pushes nearly $14 billion out the door, what exact mechanisms do they have in place to protect themselves from an economic downturn or a sudden spike in loan defaults?
Well, the answer lies in a super vital concept called the allowance for credit losses, or the ACL. Basically, it's a financial safety net. It's a specific reserve of funds set aside just to cover potential losses from loans that might turn sour. So don't think of this as some optional perk. It is a strictly required cautious buffer against future economic turbulence.
And the crucial point here is this figure, 1.16%. Trustmark has reserved 1.16% of its total loans specifically for this safety net. Now, 1% might sound like a tiny fraction, right? But remember the sheer scale we are dealing with here. That 1.16% actually amounts to over $160 million sitting in a protective reserve fully set aside for credit losses.
But why on earth do they need a $160 million buffer? Well, because of something called non-accrual loans. These are loans where the lender has officially stopped counting the interest income because the borrower is significantly overdue. The best way to think about this is like a software company pausing its expected subscription revenue because a bunch of customers just stopped paying their monthly bills. It hits the revenue stream immediately.
And the realities of lending are pretty apparent when we look at the linked quarter data. In Q4 of 2025, non-accrual loans sat at $84.4 million. But in Q1 2026, that number rose to $96.7 million. The source material notes that this $12.3 million uptick is primarily tied to a single commercial credit. So this data point alone perfectly illustrates exactly why having that massive ACL safety net is a fundamental requirement in banking.
Now, beyond just the loan reserves, we also have to evaluate the entire foundation of the bank itself, and we do that with the CET1 ratio. This metric compares a bank's core equity capital, the most loss-absorbing funds like common stock, to its risk-adjusted assets. It's basically the ultimate regulatory metric. It measures a bank's broader financial cushion and its ability to absorb severe financial shocks.
For Trustmark, that CET1 ratio sits at a really robust 11.70%. Investors and regulators absolutely rely on this specific number to gauge a bank's overall stability and solvency. So, seeing a healthy double-digit ratio like this indicates a very comfortable cushion against regulatory risk.
All right, moving into our final section, returning value to shareholders. Let's talk about what all this means for the owners. How do all these complex mechanics we just went through actually translate into value for the people holding the stock? Well, we figured that out by looking at tangible book value per share. This is a very conservative, no-nonsense estimate of what would remain per share if the business sold off only its hard assets and paid its debts. It strips away all the intangible stuff, like brand value. It's exactly like valuing a piece of real estate strictly by its bricks and cash, rather than relying on its reputation in the neighborhood.
For Trustmark, tangible book value per share for the first quarter was $30.58. And what's really fantastic to see here is the growth trajectory. That figure represents a 10.1% increase year over year. So the foundational worth of the company, the actual bricks and cash, is steadily growing for the shareholder.
And management isn't just letting that value sit there collecting dust, they're actively returning it. During the quarter, Trustmark repurchased $19.8 million in common stock, which effectively takes about 477,000 shares right out of the market. On top of that, they declared a quarterly cash dividend of 25 cents per share. So as we wrap up this journey from macro headlines all the way down to shareholder value, I want to leave you with one final thought. When you look at your own financial portfolio, are you only checking the flashy headline earnings, or are you looking under the hood to check the strength of the safety nets? Thanks so much for joining me on this explainer.